Hello, my name is Eric Rosen. Welcome to the joint podcast of 3i and the Rosen Report and the Founder Series. Today, I am honored to have our guest, Fabrice Grinda. Welcome, Fabrice. How are you today?
I'm doing very well. Thank you for having me.
Great. We're very excited you're here. So you have had an amazing career, and Forbes actually called you the #1 angel investor in the world. How'd you get there?
I'd say happenstance. I never meant to be an angel investor. I was a tech founder, and because I was so visible from the public, other founders came and asked me to invest in them, and thought long and hard whether I should do it, and started doing it, and it took on a life of its own.
So what made you a public? What made you a public figure? What was the company that you founded, and how did that come about?
So back in 1998, when I was 23, I built an eBay equivalent of Europe, and I was trying to bring the internet to Europe. And I guess the story was super compelling. It was, top of my class at Princeton. The French guy had gone to the U.S., learned the internet and the ropes, and it was bringing it to Europe. And so, it was on the cover of every magazine, the equivalent cover of Forbes, Fortune, etc., and made me very public. And so other founders started asking if I could invest with them. And look, I really hesitated for a long time because I'm like, is it a deviation from my mandate as a founder to be investing in other people? Ultimately, I decided that if I can articulate lessons learned to others, it made me a better founder. And if I could meet other founders and keep my fingers on the pulse of the market, it would make me a better founder, especially running a multi-category site, understanding what's happening in each categories. And therefore, I started doing it. And the reason I became so prolific is I think there's so many problems to solve in the world, and I want to solve all of them. And so, when you think of something like climate change, it's not one problem, thousands of little sub problems, and I want to back all the people trying to address every one of them individually.
So to be the most prolific angel investor, how many angel investments have you made?
So I've made 1,100 angel investments to date, and I see about 300 deals a week.
300 deals a week. Wow.
Yeah, and these days I'm making 200 to 300 investments per year.
Jeez, that's amazing. And so what are the most successful angel investments you've made?
Well, I was an early investor in Alibaba. I was at the beginning of Delivery Hero, which is like a DoorDash of Europe and Southeast Asia. I invested in Uber, Airbnb, Flexport, Slice. I mean, you name it. My specialty is marketplaces and network effect businesses. And these days, they're less well known because they're mostly B2B. But in the early days, they were all the consumer facing ones I mentioned.
And is it always angel round? Is it the seed? Is it the A, B, C? Where do you generally come in on those?
I'm stage agnostic. But most of what I do, my bread and butter, I'd say, would be seed and A. I rarely do pre-seed because I don't invest in competitors, and I don't want to be locking me out of a category before I've seen all the different players and see what the emergent winner is. And I sometimes do B onwards because sometimes it takes that long for the winning player to emerge. But seed and A is really my bread and butter. But it's about 70% seed and A, 20% B onwards, 10% pre-seed. And then we're also 55% US and Canada, 25% Western Europe, and 10% Brazil and India, and 10% rest of the world. And really rest of the world, like India, Philippines, Chile, Nigeria, whatever.
Wow. So to look at 300 deals a week, make 1,100 or 1,200 investments in a year, how big is your team at FJ Labs?
That's 200 to 300 investments here. The investment team is 11 people. The full team now is 33 people, given the huge back office. And so it's kind of turned from what was really a angel investing family office time approach to a venture capital firm, except we behave like angel investors. So I said what we do is angel investing at venture scale, because we take 2 1-hour meetings in the course of a week and we decide if we invest or not. So we don't take board seats, we don't lead, we don't price. We're really the former founders or founder friendly, decide quickly with full transparency, and we're there to help you.
Wow, that's pretty quick turnaround. So if you're turning around that quickly, you must have a formula with things that are must-haves or can't-have. So what are the 3 or 4 main traits that you need to make an investment, and what are the few things that are a non-starter? If they do this or don't do this, that they're out?
So I want four things, and they are all required. So, one, I need to like the founders. Two, I need to like the business. Three, I need to like the deal terms. And four, I need to like the thesis and the problem that they're solving. And what we're looking for each of them is thus follows. So, A, I want founders who are both visionary, extraordinary, eloquent spokespeople, but can also execute. So, the Venn diagram intersection of people that are extremely eloquent and visionary, but can execute is actually rather small. But you need both, because someone who is very eloquent is going to be able to raise money at a higher valuation, attract better people, is going to get more PR, better BD deals. But if you don't have the execution skills, maybe you end up with whatever, Theranos. And if you have someone who knows how to execute but can't speak, they're not going to be able to raise, and they might build a small, profitable business. Number two, and I care about all four. I care about the TAM and the unit economics. And even pre-launch, even someone pre-seed needs to be able to articulate what the estimated unit economics will look like based on having done landing page analysis, customer acquisition costs, estimates based on the CPCs and the conversion rate to purchase. They need to know the average order value of the industry and the contribution margin, and they better be expecting to be in line with the industry averages. And people who don't know that, to me, speaks to the fact they probably can't execute. Number three, the deal terms need to be fair. Now, nothing in tech is cheap, but is it fair in light of the round, the traction, the team, and the opportunity that they're doing? And we see so many deals, we really know where the median seed round, A round, B round, et cetera, is at. And number four, we're purpose driven. First of all, we want to solve inequality of opportunity, climate change, and the mental and physical well-being crisis. And in each of these, we have clear theses on the future of work, the future of food, the future of real estate. Are you in line with this thesis, and are you solving a problem we care about? And we want all four to be true. And then based on pattern recognition, because of course at this point, we've invested in 1,100 companies. We've seen so many companies, and we invest in about 1% of the companies we see. We're able to make a very quick decision.
Wow. And so you told us the four traits that are kind of the must-haves. If you see, is there one or two things that if you see, you're like, I'm out right off the bat? Obviously, if you don't like the founder, but I'm saying apart from that, are there terms or things that are just non-starters for you?
They're kind of all related to this, right? Like, so if you don't know your business model, maybe some of these companies. So look, the 5-year survival rate of a startup is about 5%. But if you at launch don't know your business model, probably it's 0.1%. And so we're already talking like a 500x.
Yeah.
And there are great businesses that started with no business model. Google and Facebook are examples of that. But it wouldn't be the type of things I do, because I'm not trying to play Moneyball. I'm playing Powerball. I want most of my companies to make money. And to date, we've had, and by the way, to be the most prolific angel investor in the world is very easy. To be the most successful angel in the world, meaning you actually have exits, and we've had 300 exits. We've been compounding at 39% IRR for 5 years. That's way harder. So to be the best, you need to have exits. And we've made money in half the investments we've made, frankly, because of these four heuristics. So we really want you to have a business model. We really want you to focus on your burn and your unit economics, which no one cared about in 2021, but finally in 2023 has become normal. And we care about valuation. There's some VCs who are like, well, the company's going to win the category. It doesn't matter what price you get in. It matters that you get in. And we don't feel that's true. If you get in at 5 and you sell for 50, you're going to do okay. But if you enter at 50 and you sell for 50, you get your money back. And if they sell for less than that, you don't. And the reason we've made money in over half of our investments, slightly over half, 52, 53%, is because we've been disciplined on our price.
Well, I can tell you this, I am definitely not going to be confused with the most prolific angel investor of all time. I've made about 30 out of my PA, and I can tell you that I have lost money on a lot more than half of my investments. So it sounds like I should be giving you my money. So I want to ask this question in two ways. One, what are the biggest investment mistakes that you see others make? And two, what are the biggest mistakes that startups, the founders make?
Yeah. So different types of mistakes. I think that what I didn't like as a founder when I was talking to investors writ large, frankly, is just the lack of transparency, people not getting back to me, people not respecting my time, showing up late on calls. And frankly, I do a call with a VC or an angel. I would think it would go very well, and then they'd ghost me. Instead of
Yeah.
ghosting me, just actually give me, if you don't want to invest, that's fine. Just tell me why not, what I would need to change if I need to change, and do that. Now, it's more of a behavior towards angels in terms of like creating your credibility, towards founders in terms of creating your creativity. In terms of mistakes, they're both mistakes of omission and commission, right? Like, so there are companies you probably should invest in that you don't, and we've all made those for a variety of reasons. And then there's companies you probably should not invest in that you do invest in. And what leads you astray? Look, we stick to our knitting, right? When you're a very smart, successful person, you have a tendency to believe you know everything and you can do anything. And the reality is that's not the case. And we sound like we're very prolific, but the reality is we do have a specialization. I studied market design in college. I've been building marketplaces. The biggest marketplace I built is a company called OLX. It's 11,000 employees in 30 countries. It's the most successful classified site in the world. It's what Craigslist should be if it was run properly, with like mobile first, integrated payments and shipping, pre-moderated content, female friendly, no scam, no spam. And it's the leading marketplace in all emerging markets like Brazil, Latam, Ukraine, Russia, Eastern Europe, etc. And as a result, because I've been running marketplaces, I focus on building and investing in marketplaces and network effect businesses. I don't go and do biotech and green tech and hardware, etc. So I think many people are led astray by their own success and do things where they don't have expertise.
Yeah, I like to say that, I ran a $1 billion hedge fund, and mandate creep, knowing what you're good at. And I think what happens in periods of time that are euphoric and it's hard to find stuff, you start going astray and trying to do something that's not a core competency. And I would say 99 out of 100 times it ends in tears. And so,
Absolutely.
when I was in my fund, we did what we did and we didn't, look where we weren't an expert. So I think that's a really, really good point.
Yeah, I mean, you look at it in life, right? Like, there's very successful neurosurgeons or whatever, heart surgeons, and because they're so good at what they do, then they're like, oh, I'm going to be great at investing, and then they lose all of their savings. And so, know what you're good at, and it doesn't make you good at everything else. There's mastery. Now, to answer the second question is, what are the biggest mistakes founders make? So, what kills companies the most in the top 3, 4 is, one, not finding product market fit, but that's not a mistake. Number 2, a much bigger mistake is fighting with your co-founders. If you can't agree, it'll tear the company down. Now, what's interesting is companies with co-founders on average do better than companies without co-founders. But when the co-founders fight, it kills the companies. It's 2 or 3 is the right number, not more, not less. And number 3, actually raising too much money at too high a price. There is a fair valuation for your company, but there are moments where a company gets hot and frothy. And of course, if you're a founder and someone tells you, hey, I'll invest 50 at 150 pre, 200 post, 25% dilution, it sounds more compelling that I'll invest whatever 10 at 30. But if your company is really worth 10, 30 pre, 40 post, same dilution, in one case you raise 50, the other case you raise 40, and you're like, wait a minute, why would I not take the 50? The issue is, if you do not grow into your valuation, it will kill your company. Because if you have to do a down round, there's an anti-dilution provision which reprices the prior round, and most often will kill the company. So it's a huge mistake many people made in 2021, where now they have to do either down rounds or they have to do structured rounds. And maybe the example I gave from a valuation perspective is drastic, but if you don't grow the valuation, it's a big, big deal. So you really should think through, what is the correct amount of capital you need? Because at the end of the day, by the way, the valuation which you raise is a vanity metric. The valuation that matters is the valuation which you exit in the end, and you need to set yourself up for success.
So you're the expert, and I'm clearly my venture track record does not look like 39% compounding for 30 years. So, but the one thing I'd say is, I've sat on boards of startups. The consistent theme I see as one of the big mistakes is they don't raise enough money because they don't think. I sit on a board of a company like, oh, we're only going to need X. I go, that's going to last you 6 months. What you can't do that. You need like 10X. So I think I find that a lot of founders think they're going to do it so quickly and with so little money, and it ends up taking more. So I thought it was interesting. I understand why you said what you said, that raising too much and anti-dilution for the down rounds and everything. But I
That's
find
not raising too much, really raising it too high a price. You can raise a lot as long as you don't spend it. The problem is when people raise too much, they spend it.
yeah.
As long, like we push all of our founders, raise at least 18 months to 2 years of cash.
Yeah.
And for the most part, I don't see them deviating from that, especially today. I mean, but frankly, even in 2021, everyone raised 2 years worth of cash. So I don't see that as being too big a problem.
Okay.
I think people trying to raise too much at too high a price and then not getting their teeth kicked in when the market says no, especially today, is a much bigger problem.
Okay, so I want to wrap up this section, but on one last question, and that is, as you make investments, you gave us your four must-haves. Do you look at the ownership structure of the co-founders, how much they own, and is there a percentage, if it's 2 or 3 founders and it's now the seed round? Do you as an investor, I don't want them to have too little because I don't want them to be diluted, down to nothing, and then they're not incentivized. So, is there a number that you look for them to have?
Yeah, I mean, the cap table construction matters a lot. The founders, especially at seed, need to have collectively, whatever, 70, 80% of the company. The pre-seed, probably they raised one at 4 or 5 So these angel investors have like 20%. Maybe they have a few advisors by the end, plus the employees. Yeah, they should have 60 to 70% of the company at that stage. And if for whatever reason it doesn't look like that and someone else has 50% of the company, that then we would not invest because of the cap table construction. We want the founders to be incentivized properly. Now, the split between the founders is less relevant to some extent because let's say you're 3 in your 100% pool, wouldn't be shocking if the CEO is 50%, the COO has 30%, and the CTO of 20%. And then it depends, right? If you're building an AI company, the CTO is a lot more. If you're building a multi-sided marketplace, maybe the CTO is 10 or 15. So, but sometimes they split equally. It does that matters somewhat less, actually.
Okay, thank you for clarifying that. So a lot of pain has been taken in crypto markets, and you and I have had crypto discussions before. What do you think about them today? Who are the ultimate winners? And is it going to look like if you invested in Bitcoin, you're going to prevail over the next 5 years in light of the crazy money and inflation and concerns?
I'm not particularly interested in Bitcoin,
Okay.
just because it's kind of like digital gold. It doesn't really have a use case. I like assets that generate cash flows, right? Like for me, assets where it's discounted present value of future cash flows is something I can wrap my head around. So I'm way more interested in applications on the Ethereum blockchain because if you want, Ethereum is whatever, AWS, but decentralized, on which people are building applications. And there's a whole bunch of really cool products there from in the DeFi world, like the Uniswap of the world, or the Aave and the MakerDAOs, to all the different types of applications. Or Render. Render is a really cool product where it's decentralized GPUs allowing people to run AI or graphic intensive applications instead of like buying massive server farms of like NVIDIA graphic cards. And so things like that are really cool. It feels to me like we're turning a corner, meaning now that the Bitcoin ETFs are being approved or likely to be approved and are coming to the market, that liquidity conditions have improved, and that some of the overhangs, like people were worried that Binance might blow up, that Tether might be a fraud or like seemingly dissipating, I suspect things will look better. Definitely in 25. I'm not sure about 24 just yet because I'm still worried about the macro. And there are clear use cases. In fact, I'm building a yield-bearing stablecoin in crypto right now to try to replace USDC and USDT. So I'm still bullish on the category. And by the way, it's true both of crypto and the web writ large. Everyone's been bearish because people have a tendency to be pro-cyclical. These are the very best moments to be investing. Now, all the poseurs are gone, the people that were in it for the quick buck. You have people that are true believers, and they're now unit economic focused. They're making sure they're not burning too much capital. They're being sensible with the capital they're raising. They're keeping capital for 2 to 3 years and growing in a sensible way. There's way less competition. And yes, entry multiples are lower and exit multiples will probably be lower. But if you win the category, you're going to win. The very best investments of the 2010s were made in 08, 09, 2010, 2011. I mean, Uber, Airbnb, Instagram, WhatsApp were all built and invested in those time periods. For me, the most interesting investments of the 2020s will have been made in 22, 23, 24. And that's true both in crypto and in the web writ large.
That's amazing. I do remember reading a story that I want to say it was 2009 or 10. The founder of Airbnb tried to raise $150,000 for 10% of the company. And he had all these notes, like it's a horrible idea. He had all these emails from major VCs that basically told him to pound sand. So, I think you'd have done pretty well spending $150,000. That was clearly one that I did not see. So on that same topic, smart contracts, when will we see them really become more prevalent? And when you buy a house, there's all these nightmare stories about people steal the title of your house, or when you're buying anything of value, car, art, house, boat. When will we see the proliferation of smart contracts come to the market?
Yeah, so you're talking about smart contracts in the context of real world assets,
Yes.
which I think is actually a mega trend and is coming. But I don't think it's going to come, especially for these types of assets, where frankly, title for a house works reasonably well in the US. It's really well. And there's a process that works well. I suspect that it's mostly going to come for traditional finance. And so the use case that we're currently building, for instance, is creating a stablecoin backed by US Treasury bills. And so once you send me US dollars, USDC, I actually go and buy T-bills, and then I give you STUSD, which is your representation of those T-bills, which you can then interact in DeFi with. And so I think these things will be more compelling because settlement is faster, the costs are cheaper. I mean, think of the traditional financial world where if you want to sell the stock, it goes through a custodian to a broker to a bank. It takes 2 days or 3 days to settle.
Yep.
It makes absolutely no sense. You can't send it from you to me directly. And so I suspect that the real world asset, smart contract adoption will come through traditional assets, first with T-bills, then with bonds, and ultimately probably with stocks and others. And I think everything else will come way, way later. And the year where this will start becoming common, well, it'll start in 24. It'll be more common in 25 onwards. But starting T-bills, which are frankly the main use case of it.
Amazing. What do you make of the AI craze? And on that same vein, the founder of OpenAI not owning any shares.
So there's been many crazes, right? The smartphone craze. There was the Web3 craze for a while. There the social network craze, the search engine craze, and as ever, I suspect that there are hype cycles where, in the short term, we overestimate how impactful they're going to be, and yet in the long term, we underestimate the impact they have at societal level. And right now, we're probably just past the peak of the hype cycle where everyone was investing. I mean, even though tech writ large was in a recession, AI was like where capital was pouring. If you had the AI word in your startup, you could get crazy valuations. And I think a lot of these are going to end in tears because people invested in non-differentiated AI companies with no moats, no business model at insane prices. That said, for society, what they're building is going to be extraordinarily valuable. So what I make of it, most of these companies that have been built are probably not super compelling yet. From a business perspective, I don't think they'll lead to great investments, but they will little by little improve productivity in the economy. We are going to see a productivity revolution. I mean, we see it in our startups, which of course are early adopters of AI, where they're using it to help program, to do customer care, et cetera. And ultimately it'll seep into larger enterprise. But, by when will a large insurance company use it to process some medical claims? That's a decade away, right? We need to deal with that hallucination, et cetera. When it does happen, it'll lead to a real productivity revolution, but it'll take a long time. So it's real, it's happening, it's been overhyped. There's probably going to be the valley of despair, et cetera. And ultimately it's going to be transformational, but it'll take 5-10 years to get there. And I would only invest in it if you get in at reasonable valuations in a vertical application that has differentiated data and is doing something. If you're using OpenAI as your backend and you're giving an open source all of your data, you have no moat. Someone will go and kill you, and possibly OpenAI. So I wouldn't do it that way at all. In terms of who owns what shares, et cetera, the look, different ways to fund these things and cap structures that you can use. You can open source. You don't need open source. I mean, there are different business models, right? Like think of what happened with Linux, and then the companies were built on top of Linux. So that's a choice in terms of how to build the community and get developers. But you can build a business model on top. And also, if you're wealthy enough, maybe you don't necessarily care. I don't do this for the money. I do this to really better the world. And I think that the political system is structurally incapable of addressing the challenges of our time, which are typically beyond borders, climate change, equality of opportunity, et cetera. And that's why I'm using the deflationary power of technology and its ability to improve user experiences to address these problems. I actually, even though and the reason I'm doing it in a for-profit way is it's scalable, sustainable, and you actually have a metric to make sure that you're doing the right thing. But I don't need to work. I could have retired 20 years ago.
Well, that's a great answer. You talked about the quality of deal flow being so much better today, and you said the good deals were done in 2008, 9, 10, and in this section it'll be 22, 23, 24. Can you tell me a couple of the deals that you've done in the last year or two that you're the most excited about, that you think has the most trajectory on the upside?
Yeah, so I'll start by the thesis. So if we've not been investing in AI like everyone else in the last few years, the time to invest in AI would have been 5 years ago. What we've been doing instead is digitizing the business world. So if you think of these crazy, amazing, beautiful user experiences you have in the consumer world, Amazon, DoorDash, Uber, Airbnb, in the business world, you have none of that, right? If you want to buy petrochemicals, there is no site where you can see what's available, what's the manufacturing capacity, what's the pricing, and then track payment, pay for it, get insurance, track the delivery, et cetera. And so we have 5 theses in B2B marketplaces. One is writ large, bringing the discovery of inputs, petrochemicals, steel, gravel, et cetera, online with full transparency. And by the way, when I described like putting the catalog, putting the pricing, getting a connection to manufacturing capacity, ERP integrations, payments, I mean, these could be different companies on one. And so we're investors in Nodi, which is a petrochemicals marketplace, Shootflix, which is a European marketplace for gravel, or Metal Loop, which is a marketplace for steel in Europe as well. Number 2, B2B enablement, right? Imagine you are a small business owner. You're Luigi and you're building your pizzeria. You never got into those because you like to create a website and answer comments on Yelp and deal with accounting and negotiate with Uber and pick up the phone and create a delivery source. You like to cook pizza. You like to talk to your customers. And now you need to do all these things in order to compete with Domino's. And so our thesis is both helping the SMBs compete with the large chains and B, helping them do the things they love and doing everything else for them. So we're investors in a company called Slice, which is basically helping pizzerias do all the things they don't like. Pick up the phone, create the website, provide them with a POS, et cetera. We do the same thing in the coffee category with a company called Odeco, which helps the coffee shop owners. They just want to be baristas. They don't want to be dealing with like inventory management. And so what's amazing with Odeco is they have a purchasing power of hundreds of millions of dollars, so they get better prices on coffee. They have the keys to the coffee shop. So they go at night, replenish your inventory, not bother you, and give you better pricing. So very high NPS. We do the same for Fresha, for hairdressers. We do the same with Joe Box for locksmith. I mean, and the list goes on. We do it for bodegas, helping them source, et cetera. Number 3, as you know, many companies are intelligently moving their supply chains out of China. So friendshoring is a mega trend. And so we're helping, or we're investing in companies that are moving supply chains from China to India to then export to the West. And again, it also falls in the SMB enablement because these are mostly mom and pop factory owners in India who, what they want to do is manufacture. They want to be answering RFQs and dealing with payments and tracking, discovering clients and creating prototypes, et cetera. So these marketplaces do that for them. And so we're investors in Ziad, an apparel marketplace, Dukan, a rug and linen marketplace, and Shimcart, which is a ceramics marketplace. And you think of the category, we're investing in it. Number four, we're investors in labor marketplaces to support this. So Trusted Health and Nurses Marketplace that is doing hundreds of millions of bookings and traveling nurses, or RigUp, which is helping, it's now called WorkRise, oil services workers work on oil platforms, or Job and Talent helping low, I guess, blue collar workers work for Uber or Amazon in Europe. I mean, the list goes on. And last but not least, we're investors in the companies that are supporting all of this. So for this to work, you need global transportation. So a company like Flexport, which is an amazing international online freight forwarder company, or ShipBob, which is helping local or offline retailers compete with Amazon by doing picking and packing, and shipping, and maybe even same day delivery. I mean, and the list goes on. So these, I'm giving you a lot of companies. Many of these are already billion-dollar companies, even though no one's heard of them, and they are absolutely crushing it. And I'm excited to see when digital penetration in B2B goes from 1% where it is today to like 20%. These are going to be 10, 20 plus billion-dollar companies. So it's very, very exciting. It's slow, it's boring, but it's amazing.
So you think B2B is where the puck is heading next?
Absolutely.
Okay. So there was a New York Times article maybe almost 10 years ago that talked about you giving up all your possessions, and it got down to 50 items. And I want to say, if I remember right, a pair of socks was 2 items, I think. In that pair of socks
was 1 item.
A pair of socks was 1 item.
Yeah.
Okay. How'd you get there? How long did that last? I would last like the day. So how did that happen?
It lasted for 4 years.
Oh my God.
The logic for it. So everything I owned fit in my carry-on, because of course I didn't want to check anything. My tennis bag, because of course I still need to play tennis and paddle, and my backpack, which had my computer and Kindle. The logic for it was twofold. One is, as we get older, I found that the quality of my friendships was fraying, in the sense that when you're a kid and you're in college, you're remaking the world, you're seeing your friends 24/7, you're daydreaming about the future. And all of a sudden, people get busy with work, with wife, with kids, with husband. And instead of seeing them weekly, you start seeing them every 6 weeks. And when you meet them, it's no longer, let's remake the world. It's a biographical update. In the last 6 weeks since I last saw you, this is what happened at work, my kids, etc. And it's okay, but it's not the reason we became friends to begin with. And so I decided, you know what? I just sold my company. That was in 2013. I sold OLX. And I now have the flexibility and freedom to invest in those friendships. Maybe if I want 2 things. Go back to first principles. If you have an apartment, you go there. If you live in a city, you go there. If I have nothing, every day I can ask myself, where do I want to be? What do I want to do? Who do I want to see? And then by having no obligations, I can try to go and rebuild proper relationships with my friends and family, considering that I've been working 100 hours a week, 7 days a week for the last 20 years. And so I tried a few approaches. I went couch surfing first for my friends' couches, which was actually not a winning strategy, because ultimately embedding myself in their life when they themselves were still busy with kids and work, et cetera, it didn't work. So I iterated a lot on that model. So within 6 months, I decided, okay, that didn't work. I lived in Airbnbs. So actually, I lived in Airbnbs in New York, which was amazing. There were all these billionaires that had like these $20, $50 million apartments that were empty. And so I could be in every neighborhood like for a month in these beautiful places and host amazing events, et cetera. And so that distributed living and beautiful Airbnbs around the world, I absolutely loved. And I found a way to rekindle with my friends, not by living in their couches, but actually bringing them together at places where it was easy for them to go to during school vacations, where there were activities for their kids. And so I did it around my birthday in August and every Christmas and New Year's, to the point that now I fly 50, 60 people every year to my place in Turks for Christmas. My family and my extended family, so my last name is Grinda, we call ourselves the Grindaverse. And it's super fun, and it's been an amazing way to reconnect with friends and family. The reason my asset-light living ended is twofold. First, New York passed anti-Airbnb laws, and so all this inventory disappeared in 2015, all the high-end inventory. And then number two, I more recently started having kids, and now I have a son who's 2 years old. I have a daughter who's going to be born in February, and I have a 5-month-old puppy. And those three things are not asset light. Let me tell you that. I could have 50 items, but I think my son personally has 5,000 items, and no longer is compatible with asset light living.
That's a great story. I hadn't realized, the extent of what you did it, and that's fantastic to hear. In a similar vein, I retired early. My dad died when I was 5, and I don't ever remember anything about my dad. And I wanted to give my kids something I never had, which was a present father. And I, for the last 7 or 8 years, have been with them, full time, which has been great. Now I'm at a different stage. They're 17 and 16. Dad isn't nearly as cool as he was a few years ago. So I need to go find something else to do now. So, you live an interesting life with a lot of hobbies other than tennis, which you highlighted. What are a couple things that you like to do when you're not couch surfing on your friends' couches?
I kite surf. I heli ski. I play padel, which is a tennis derivative, if you want, which is big in Hispanic countries. And I do adventure travel. For instance, earlier this year, I walked to the South Pole, pulling my 100-pound sled in -50 temperature.
It doesn't sound like a lot of fun.
Fully disconnected. And I've done things like that where I've crossed Costa Rica on foot and bicycle from the Atlantic to the Pacific with just my tent and sleeping bag and water filtration.
You lost me. I'm not doing either of those.
I do a lot of these things. And then in non-athletic hobbies, I read 50 to 100 books a year. I write a blog on whatever crosses my mind, from macro to tech trends, to book reviews, to whatever. I love writing. And that's basically it. And then I'm trying being a cool father, because to a 2-year-old, you're still very cool.
Yeah, well, enjoy it while it lasts, Fabrice, because let me just tell you, that coolness don't last forever. At 17, you're not going to be that cool. So it's been great. Let's end it with, what's your favorite part of being a 3i member?
The community has been meeting amazing people. Like we're playing in poker tournaments that I host or join. Actually, we've got a lot of investors in my fund out of 3i, and seeing amazing opportunities. So it's been fun. I love Mark and what he's built, and I've loved and known him for forever. And I'm very happy to be a part of 3i.
Well, we're very happy to have you. This has been a very enlightening conversation. I know all those who have the chance to watch will learn a lot from. So thanks for taking the time with us, Fabrice, and I look forward to seeing you again soon.
Thank you for having me.
Thank you.